Are you investing in yourself, in your idea, and converting it into an invention that has commercial value? How do you use your resources? How do you use others? What are the different forms of funding and financing for an idea? How do you convert that into an actual product, technology, or service to bring to the marketplace? So let's begin with what people call the 3 F's: friends, family, and fools. And we're not joking. It turns out that a lot of the startups that we have that are inventors and creative people need to understand that neither the investment community, unless you have Uncle Joe or Aunt Sally that wants to put money in early stage, are going to put risk money into an idea at the preliminary stages when it hasn't achieved intellectual property protection, filings, hasn't had searches, sometimes a prototype hasn't been built, a model, nothing has been flushed out yet at the earliest stages. So it's very, very difficult, if not impossible, to get private equity investors. For that matter, it's very hard to get debt funding, such as you would get from a traditional bank, whether it's SBA guaranteed or otherwise. There are a whole slew of new banking programs, microloans, and all the way up to purchasing buildings with a low percentage down because it's a tangible asset, but you're not at that stage that we're talking about right now. So essentially, friends, family, and fools will just chuckle and say that could be other people that are your friends, associates, well-heeled people, folks that believe in you, that might give you some early stage capital. But we're talking about the frontier of an idea at this point, where you have to know that you can own it, the intellectual property rights, know that it's feasible from both a technological manufacturing, offering a service, and how it can be commercialized. So those very early stages may rely upon your use of your own good credit, and we want you to always keep that and not put it at risk. It's one of the fundamental errors that a lot of startup inventors and entrepreneurs make, small businesses, about risking everything for that great idea until you really resolved it and figured out whether it's going to be commercially successful and how the crossover point will take place, where you're moonlighting of the idea while you keep your day job, or if you're a student or have a family or whatever it may be, your normal routine can cross over to you're making an income that substitutes your other sources, and then you're on your way, whether that be licensing or manufacturing a product and selling it as an entrepreneur. So, tapping into friends and family may be one of the first solutions, as well as your own credit lines, or like we've often suggested, try to do what companies have to do. Take away a percentage of your own income, whatever those sources are, for a while and store it away, like 10%, something like that, so that you will have the resources to pursue the early stage of the ideas where you won't be able to tap into other people's money, So those kinds of savings done right, we're not talking about a lot of money right now, and there's a whole myth about what it costs at the front end of this. Through our nonprofit incubator, it can be very, very low cost. We're talking about maybe hundreds of dollars at the beginning instead of many thousands to prove an idea, test an idea, find out whether you can own the rights to it, etc. So let's think about that. The 3 friends, family, and other sources that might be able to help you. The next stage is, if we've proven the idea and we've searched and filed for intellectual property, then we can start to look at the other avenues of using other people's funding, whether that be banking institutions or other financial institutions, or high net worth individuals and accredited investors such as angels or venture capital. Most likely you won't even be in the neighborhood of venture capital at this stage, because that has to do with institutional funding and a lot of issues of taking control, losing control, the long range possibilities of mega sales around a global economy. And we're now talking the venture side has converted itself, flopped from its early stages when new ventures were started with new venture money. And now it's very much at a higher level, hundreds of millions of dollars, tens of millions of dollars, sometimes even more than that. And it's by combinations of groups and venture capitalists and financial institutions. And it's a powerful arena if you get to that stage. But right now, we're talking about that early sampling of potential money that might be available to you to help you progress your idea. So let's talk about that. Banking will not look at you, won't talk with you sincerely. In reality, every form of banking that I know of, unless you have a business plan put together. And nowadays, it isn't a matter of hiring somebody or getting some template or somebody else isn't just borrowing it and refashioning. You have to be able to address it to the audience that you're funding. You have to address it to the audience that you're trying to solicit for that loan or that equity money. And we're talking about debt funding, where you must pay it back with whatever the conditions are, interest rates or whatever, collateralized or not. That can get you into trouble if you're not careful about that, because you may have to put up resources, real assets, house, car, motorcycle, boat, whatever, so that that loan will be guaranteed to the institution that's fronting the money to you or giving you a credit line. So that's one of the sources that you have to be concerned about, debt capital. And most likely that isn't going to happen right away, and that's why you have to put together a business plan, something that's smart, is together, intelligent, has real numbers attached to it. Now, in our incubator, Green to Gold, we help with all those resources. We have many models, we have a lot of expertise in writing that kind of a plan. In fact, for the equity side and also work for the debt side, we have a very special program of a very well-proven funding template that now drives not only the business plan and how that's constructed and how that looks and how it's presented, but also what we call the pitch, the presentation to potential investors, or in some cases bankers or other loan sources, credit unions, etc. And it's very exclusive. It's one that has proven itself over the vast experiences that I've had and our organization have had serving on boards of directors and associate situations with angel venture capital groups, having annual funding pitches, investment events, conferences, actually doing and presenting on many panels in this country and abroad about how to finance. So we put all that together, all that know-how, that current way that investors and banks want to look at you, what they must know, the answers directly from the questions from the horse's mouth, so to speak. That's the most important thing that you need to know, is that we have those resources to help you. Okay, so now we've talked about friends, family, and fools, and your own funding where you can, setting aside some savings to get started, to invest in yourself, and now we're starting to talk about debt financing and equity funding. There is another layer that is very interesting, and it's called unconventional or alternative funding sources. And that is represented by what's called asset-based lending, invoices, purchase orders, contracts, grants that are about to come to you from government or philanthropic agencies, or other sources of income that are absolutely assured, but they're off in the near future before you actually get your hands on those funds. And so that alternative funding, the alternative funding exists to advance you the money to do R&D and manufacturing and right to the point of packaging and sales so that you can take the revenue in from fulfilling those orders or those services that you might provide. You pay the alternative funders back the original principal that was advanced, and they get a percentage. It's not like Shark Tank, and it isn't giving away your shirt. It's a percentage that's reasonable as a commission to what they did. And they want to work with you long range. You want to be there when you need more money because you're going to be selling more products or doing more services or whatever it may be. And so basically, it's working out a relationship with them, and they know who you are, and you're paying them back, and you're able to come back and reuse the funding or expand that funding so that you can grow and expand. Now, in our case, within our incubator, we actually have 4 established relationships. for alternative unconventional funding. One is what they call non-recourse. All the rest of them are recourse. Recourse means that if they don't pick up the money, they could go after you and sue you. And that's a risk that you have when you sign up and people give you money and you're supposed to pay it back, okay? Even when it isn't collateralized. There's even a wrinkle of that has to do if you're a merchant and you're using credit cards that are paying you, buying products and stuff that they can advance on that by an average, and it's a little bit complicated, but basically they're giving you funding based on what's about to happen in your history. But back to the whole issue of recourse, non-recourse. A non-recourse funder, an advancer of funds, means that they're insured, and if there is a loss and for some unfortunate reason you don't pay them back, they're not going to lose their shirts on it. But everyone else basically has some recourse and pledges you to and contracts you to be able to commit to funding, paying the funding off within the periods of time that are understood and the percentage that they get. So now we've covered different ways to start to pool other people's money. Now when it comes to angel investors, by the way, the name angel investor actually came out of the entertainment industry. Early in Broadway's history, theatrical history, there were people who would finance those arts. And they started to be called angels, and it caught on, and now there's angel networks around the world. There's clubs, there's groups, there's collaborations, there's syndicates of angel investors. That's where most of the money comes for the kinds of inventions and products and technology that we deal with in the Green to Gold incubators. So, as I mentioned, venturing into venture capital, and some people call that vulture capital because of the conditions at stake. Some people call it vulture capital because of the conditions that might be imposed upon you for taking those large amounts of money to really jump and expand your business in a many tenfold or more way. But right now we're talking about high net worth individuals, people that are accredited, associates, and people that can afford to take the risk, either individually or in syndication with others, to invest in your proposition, in your business plan, in your technology, in your idea. Once it's matured, and we've gone through all the steps that we've covered in this course, there is a brand new wrinkle to financing. And that brand new wrinkle to financing is something that nonprofits and charities have used for a long time, or from the very beginning of time, and that is crowdfunding, peer-to-peer. People collaborating to assist in the building of a city, a community, a business, an enterprise, a technology. And for nonprofits that we incubate, that's an excellent source when it's driven by a mission, a public benefit, social, environmental responsibility, whatever it is. You can raise money in crowdfunding by soliciting, and now with the internet and global, that can be in a really large scale. Well, something has happened in this past recent years of the Obama presidency. There was a special Jobs Act put together that was coming out of that deep recession that affected the whole global environment, financially and business. In that Jobs Act was a special arrangement where the Security and Exchange Commission, the SEC, would promulgate new rules, regulations, so crowdfunding could expand to being lots of individual investors investing in an enterprise, a venture, and being able to raise money that way by what's called the tribe that you have, the community that you've developed, and solicit that to pay for the production and sales of products and services. Some of the most famous, of course, are now Kickstarter, Pros and Cons, and Indiegogo, and a whole bunch of others. Now there's some 4,000 different platforms, with my last count, that are available, and you can create your own platform. We even have one that has to do with sustainability that's growing. So, and we also now have an alliance in Green to Gold that has to do with, of all things, traditional banking and investors that were in banking, and this new opportunity for equity funding from crowdfunding. How do you package yourself legally, financially, accounting-wise, the presentation, not break the rules, not get into trouble, and be able to solicit funding in many kinds of forms, whether it be stock or units or profit participation or anything you can dream up that all the parties agreed to. How do you do that, meet the SEC rules and regulations, and be able to raise capital in a crowdfunding nature? We have that resource that mentors and tutors you, along with us, our coaching, to package yourself in a way that you can launch that campaign in crowdfunding. But it still will come down to the issue about whether you have a community or a tribe that will follow and support you. Now, in the case of the Kickstarter and similar ones of crowdfunding, how that's worked is it's called reward-based funding, where you offer a brand new product coming into the marketplace at a huge discount or first shot at it, some special reward for those people buying in advance, giving you money. In the case of Kickstarter, you have to meet the goal that you set in setting up the arrangement with the Kickstarter platform. If you say you're going to raise $50,000 and you only get 45 or 30, you can't keep that money. You fail to reach that goal. Other forms of crowdfunding sites will allow you, those platforms, to keep whatever you do raise. And it is a wise thing to start that way. And it's less of a burden, there's less financial impact, there certainly is less legal aspect about you getting into trouble with governmental agencies, as long as you fulfill whatever the requirements of supplying a product within a reasonable time that everybody knows, or the service or the reward, some kind of memorial, a memorandum, some kind of thing that, some product or special, some kind of incentive for that funding.